In this video, learn how to set up 3 pairs of indicators that can show you definitive trading signals to enter or exit your trades. With trading indicators, you can get confirmation or denial of a potential trade. Hey guys, James here. I have 3 pairs of indicators in this video. Usually pro traders will use a pair or more of indicators together because using just one doesn't really give you much context. So using 2 or more in conjunction with each other can give you the information you need to read the market and make a judgment of if you want to enter into the trade or not. I'll leave the timestamps in the description below so you can rewatch each indicator pair setup, and links to the platforms I use and other helpful videos will be in there as well. The first indicator pair we're going to look at is a really simple moving average pair. A moving average really just takes the price at each period and divides it by the number of periods. And I've set it out for you here just in case you don't know what a moving average is. As you can see, there are a bunch of different prices. Every period that you look at on the chart has a price that it closes at. So what we're looking at right now is the Bitcoin US dollar chart. And what you can see right now is I actually have 2 moving averages here. I'm just going to take these off right now. And each of these candlesticks now represents 1 day of time. You can see that up in the top left, the 1D, that means 1 day. So each candlestick right here represents the price movement over that given day. And if you don't know what candlesticks are, I'll leave a candlestick tutorial in the description for you. But really simply, a moving average pair can tell us what the trend of an asset is, and we can use this to trade. So I'm just going to put them back on the chart right now. This white line is a 200 period moving average. We're using a 1-day chart, so right now this is a 200-day moving average. I'm also going to put the 50 period or the 50-day moving average on there as well. And you can see that the yellow line actually crosses through the white line on a number of occasions. We can actually use that to trade. So one of the simplest indicator pairs you can use is 2 different moving averages, a longer moving average and a shorter moving average. So you can see a 200 and a 50 period moving average can be used in swing trading. What we can do is look for a crossover of the 50 period either below or above the 200 period. Because the 50 period moving average is a shorter moving average, it means that the price will more closely follow the actual price of the asset. The 200 period will be smoothed out over a longer time period, and you can see how it works here. So we've got 1, 2, 3, 4 periods right here, and then all you do is divide it by the number of periods. So the price at each period you can see was 49.90 here, 49.95, 50.45, and then 50.35 divided by 4. That would be plotted on the moving average graph at 50.16. However, as periods and days move on, you obviously get rid of the furthest away, and then you add in the price of the latest day or the latest period and divide it by the number of periods that you're tracking. We can use a moving average pair as a trigger for a potential trade. So let's come back to the chart and see how that would work. As you can see, this is the Bitcoin chart. And what we can see down here is a slow uptick in the price of Bitcoin over time. And you can see that the price actually did track the 50 period moving average. It was above the 50 period moving average, but below the 200 period. There are many different ways that you can actually trade this. Firstly, if the price is above the 50 period moving average, as you can see it all here, that is sometimes known as a very bullish trend, because essentially what it's saying is the price, the actual price of the asset is above its 50-day moving average. That means that the very short term is obviously way above normal for what the price was before. And so obviously it's in a bullish trend. If the price moves below the 50 period moving average, like it does here, you can say that the short-term trend is maybe to the downside. Essentially what it's saying is that the price right now is not as strong as it has been over the past 50 periods. This is really the basics of trend trading, but we can use a longer and a shorter moving average to actually enter into some trades. There's 2 things we can do. Firstly, we can wait until the price itself actually moves above a moving average. In this case, we can look more at the 200 period moving average. So you can see right down here that the price of Bitcoin actually moved above its 200 period moving average for the first time in a very long time. This obviously suggests that the short-term trend, the short-term trading is to the upside comparatively. As you can see, the 200-day moving down, which obviously changed here. There's obviously a change in the trend. Something's happened, something's moved the price up. Some traders will wait for the actual price of the asset to move above the 200-day like it did here. Some other traders will actually wait for the 50-day or the 50 period moving average to also cross through up above the 200 period moving average. This would be known as a confirmation of the trend. So as you can see what's happened, the price has moved up, and then a few weeks after we get that confirmation right here. So some traders may go early at this stage, other traders may wait for this stage to come in and try and ride a move to the upside. As you can see, as it panned out on this occasion, we would have done very well getting in either at this area, or when the bullish crossover happened around this area, we would have ridden a move way to the upside. And actually it's almost a doubling of the price. So on this occasion, it would have been a very good trade. Where you get out is up to you. When it comes to long positions, if we got in around this price, for example, if we waited for the trigger, you would obviously put the stop loss where is comfortable for you, possibly around the 200-day, or if you have watched the channel before, we've talked about the ATR. This is a way that you can enter stop losses as well. I'll link a video below if you need to know more about that. In terms of the take profit, again, this is up to everyone. If you are a swing trader, you potentially will let your position run. There are many opportunities to get out here, of course. You will never ever get out at the very top, but you can see how strong that move was. But as we carry on to look how moving averages perform over time, we can also see a crossover right here. This is actually to the downside this time, so potentially there are two ways to trade it. Either wait for the actual price of the asset to move below the 200-day, then you say the bull run is over. We had a bullish crossover to the upside here, and now we have a bearish crossover here. You would have actually made this still, so that is a potential, or you could wait once more for the 50-day to cross over the 200-day right here. It doesn't work every time though. In fact, we get another option right here, and you can see if you would have waited for the actual price to cross over the 200-day, you maybe would have gone in at this level right here at about 9,500, potentially waited for the 50-day to cross over. You would have got in here at around 9,700. It didn't work out this time. You can see the move failed. It broke down and we would have made a loss on that one. There's no real upside to that. So we would have made a loss on this trade. That is why it's important to put those stop losses in. If we just carry on once more though, we can see once again the 50-day moves over the 200-day. So you get this huge sell-off right here, and then a huge bullish move. You can see the 50-day reacting to this move to the downside, but then the actual price moves over the 200-day once again. Some traders may want to wait for the 50 period to actually cross over, which it does here. And essentially from this position, as long as you had a decent stop loss in place and you gave yourself some risk in the market, essentially it actually wouldn't have crossed back over, and you would have ridden probably one of the biggest moves ever in a single asset in the history of any stock market or investing market over time. Very easy to say this now after the move has occurred, but in general, a very simple way for swing traders to really look at positions is potentially the pair of moving averages, either a 250 period pair or whatever time scale that you want to look at. Moving on though to our second pair, we have the exponential moving average and stochastic oscillator. We know what moving averages are now. You just take a bunch of prices and divide that by how many periods there are. Exponential moving averages give slightly more weight to more recent prices in the calculation. It's not better or worse than a simple moving average, it's just used in different contexts. The stochastic oscillator is a momentum indicator, and if you're swing trading or day trading, or you're trying to trade more actively, then obviously trends and momentum is something that is very important to us. EMA and stochastic is popular for day trading and short-term trading. My own personal experience with it is that for longer term trading, if you're looking out at the medium term, it potentially doesn't have as many benefits as if you're looking at those shorter term movements. A simple way to use the EMA and stochastic is to look at a 2-period EMA and a 4-period EMA together. So like we've just seen, you can use two moving averages together, and that gives you way more context into the shorter term versus the longer term trends. 2 and 4 is not far apart though, so definitely this is more of a day trading strategy. But we can use stochastic to actually confirm that momentum. So in the previous example, we just saw 2 moving averages. Now what we're seeing is moving averages plus a secondary indicator to either confirm or deny our trade. Let's come over to another chart then, and actually this is the chart of Apple, and it really bears out exactly what we are saying with both the EMAs and the stochastic. So what we're looking at with this strategy is that we want that crossover, that bullish crossover, just like we saw in the previous example where the shorter moving average crosses through the longer period moving average. We know that the shorter term trend is possibly to the upside. The stochastic, as you can see down here, and if you don't know where that is, you can go to Trading View and then go to Indicators and then just type in stochastic like this, and it will come up for you right here. So you can use that and put it on the chart. Now what we want to do is use the stochastic as confirmation. So what does this all mean right here? Well, on the right hand side, you can see a couple of numbers. You can see 25, 50 and 75. If the stochastic is down here below the bottom end of the chart, so towards 25, that's telling us that the momentum possibly is actually quite low on this move and potentially it could be moving up. If the stochastic is very high and it's up here towards the 75 or higher, it can potentially mean that the move that's happened is running out of steam and the momentum may be changing. So what we're really seeing here is confirmation of momentum itself. And we can see right down here, we have this crossover. So the 2-period moving average in purple and the 4-period in green. And we can see a crossover right here, purple going through green. So this is a potential entry for us. We're not going to go in though unless the stochastic is also confirming it. And we can come down here. What we want to see is this blue line crossing over the orange line. We want to see the blue line crossing through and then up in a bullish way up towards the higher end of the chart. And that's exactly what's happened. So this would potentially be an area to go in, and Apple was gapping around here between closes and opens. So this is a potential entry point right here. So we definitely could go in here. And as you can see, actually down here as well is a potential second entry. So once more, we do get a crossover. We have the 2-period purple moving through the green 4-period moving average. Again, we do have a crossover confirming that. So another potential entry right here. If you would have got in at this point, or at this point, obviously that run continues. And then we see the stochastic down here is telling us that, hey, this run potentially is over. You can see it stays up at this high level, meaning that the run is still continuing. It tells us right now, this blue line crossing through, yes, the run possibly is coming to an end. And we did see a sell-off right here. So potentially a nice exit point around this price, 132, with entry points around 112 or maybe 110, depending on where you would have gotten in. Our third indicator pair is MACD and RSI. MACD stands for Moving Average Convergence Divergence, and RSI stands for Relative Strength Index. Convergence divergence, because that's exactly what it's telling us. It's telling us how a moving average is moving either towards or away from something. And essentially what it's telling us is the trend. MACD is a trend following or lagging momentum indicator. It's called lagging because it will lag what is actually happening in the market, but that's not really important for us. You can see that the MACD actually subtracts the 26-period EMA from the 12-period EMA. And then what happens is that a 9-period EMA of the MACD itself is known as a signal line and is plotted on the graph. That may sound really complex and crazy, but it is actually quite a simple indicator. And essentially all you have to do is watch what one line is doing compared to the other. So we want to see the MACD line crossing through the signal line, and we can use that as a trend indicator. When it comes to the RSI, this is a leading momentum indicator. So using a lagging and a leading together definitely gives us a nice bit of data that we can trade off. When we're looking at the RSI, much like the stochastic, essentially when it's at the bottom of its range, this is known as oversold. So if it's below 30, you might consider it oversold. Essentially, it means that the price may be quite cheap relatively to what it has been before. And then when it's over 70, it's known as overbought. Potentially the price might be a little bit expensive overall comparatively. So we can actually look at this on another graph. What we want to see is that the RSI shows us possible reversals of a trend, and reversals of a trend are a good entry point for day and swing traders. We're also going to put in a simple moving average. This is essentially just confirmation as well, so it just gives us another point of reference. The MACD is going to show us the strength and direction of that trend. So using all three of these together, it's going to give us a lot of data that we can use to potentially weed out any poor trades and only trade the good ones. So as you can see here, this is the pound euro chart, and I've already got a stop loss on here and the direction of trade, but where exactly do you get in? Well, let's come up through this slight uptrend right here. You can see that the 9-period simple moving average, so this takes 9 periods. In this case, the periods are 1 day in length. Definitely there was an uptrend in the market right here for the pound against the euro. What happens after that though is a sell-off. And so potentially if you are a bull, you are thinking, well, when is good to get in? If there is a sell-off, that potentially means that I can have an entry point and ride the next phase to the upside. But where exactly do I want to get in? Do I simply get in when the price moves up above the 9-period moving average like we've seen before? Potentially, yes. That is a potential entry point, but you can definitely see a bit of choppiness in the trading right here. We can actually use the MACD and the RSI to give us more data and really understand what the market is doing. So see right here, this is a potential entry area if you are thinking that the pound is going to be strong against the euro over the coming weeks. You may be wanting to go in here, but as you can see, there were a couple of days where trading was not great and you might have been stopped out of a few trades. You can see this level here, certainly as a stop loss. The price did come down under this level a couple of times, so certainly you may have been stopped out of some trades due to choppy trading. How do we know this? Well, look at the MACD right here. Essentially, it's telling us that the trade or the trend, the momentum isn't very positive during this time scale. What we have is the blue line, which is the MACD line, and the orange line, which is the signal line. Like I said, we want to see the MACD line moving through the signal line, which is telling us that potentially the trend is changing. The histogram in the middle just simply shows us how the blue MACD line is moving in comparison to the signal line. It doesn't show us any other data, but it's just a visual representation of how the blue MACD line is changing in relation to that signal line. So if it's to the upside and very high, then obviously that means that the blue line is moving up away from the signal line at a high rate. And any red areas tells us that the MACD is below the signal line. And obviously the further it is away, the higher the histogram goes. So you can see what the MACD is telling us on this part of the chart is that actually the trade isn't that great. The trade, the momentum, and the trend definitely not to the upside, so possibly not the best time to get in. And we can see the RSI right here is fairly low. In itself, being low, moving to the upside is something good. That tells us that the trend is to the upside, so that's potentially good. But obviously the RSI by itself doesn't give us a lot of information. We have to pair that with the MACD and also with the actual price, and also some market knowledge as well. So the RSI is in a decent position here, the MACD saying no for now, but the next stage you can see it's actually telling us, yes, this is probably a good time to get in. So we can see that the MACD line crosses through the signal line, so that's a good thing. If you want to ride an uptrend, it's moving from below the middle line or the zero line up through the signal line in a bullish fashion, moving up through, telling us that the trend possibly is now to the upside. And what we can see right here is that the RSI is also moving upwards as well. So telling us essentially that the trend and the momentum is towards the upside. This then is an area where we could potentially get in. So around this price, and you're never going to time it perfectly. If you would have got in up here, then obviously a stop loss would have been a little bit closer. When exactly do you get in? Or you might want to wait for confirmation a couple of days after the MACD line passes through the signal line, just to get confirmation that the move is actually happening. So potentially you would have gone in on maybe one of these two red candles, possibly this very small green candle here. And what we would have done is placed a stop loss, as you can see, around this level. Again, I go through stop losses in other videos and the levels that you need to put them at. For me, you can use something called the ATR. You can also look at previous areas of support and resistance. So definitely there was, I would say, a level of support right here for the price. So I would have put my stop loss around this level, maybe a little bit lower. And then obviously, as you can see, you would have ridden this move right to the upside. So that would have been a profitable trade. When you get out, possibly look at the MACD and RSI once more. You can see that the MACD is now essentially finishing this move and moving back through its signal line to the downside, meaning that potentially the trend is starting to fail and potentially stop. So it is still highly bullish right here, which is good news, but it is coming down compared to this uptrend that we saw. So potentially this area could be a sellout area, and we can see that the RSI is still very strong, but definitely moving down and trending downwards over time. So potentially any area here could have been a very profitable trade as a swing trade for you. So to recap on trading indicator pairs, moving average pairs are actually very effective overall to give you an idea of how the trend is. They're very simple, but they are very basic and they don't provide massively detailed trading info. If you want to go ahead and use the exponential moving average and stochastic, this can definitely help more to identify the momentum of the price and not just the price moves, but actually the momentum and how strong those price moves are. EMA and stochastic definitely is more suited towards day trading, shorter term trading for sure. And then when it comes to the MACD and RSI, they show both momentum and also the strength of a move, which is obviously super important. However, the MACD and RSI can show false moves, and that goes for all of these indicators. We've seen on a number of occasions in this video where they can provide, and then that move just doesn't really materialize. So that's why it's important to put those stop losses in place if you are day or swing trading. Using two indicators together though can definitely confirm strong moves and potentially weed out trades that aren't very great to get into because they don't have that strength and momentum. If you need to know more about these indicators, I'll leave some other helpful videos in the description for you. If you want to go ahead and use Binance to trade or TradingView charting software, I'll leave those links in the description as well. Do subscribe for daily helpful crypto content, and I'll see you in the next one.